Hello, this is Leroy Meadows, and I want to thank you for joining me today. Today we're going to do another example of decision making and relevant information. So we're going to take a look at this one as a make versus buy situation. And there's going to be an element of activity-based costing in here. So let's go ahead and get started. And this is exercise 11-25 at the end of your chapter on decision making and relevant information. So this is exercise 11-25. So let's get started here. The Svensson Corporation manufactures cellular modems. It manufactures its own cellular modem circuit boards, CMCBs, an important part of the cellular modem. It reports the following cost information about the cost of making CMCBs in 2017 and the expected cost in 2018. And we're given the expected cost of the current cost of 2017 with the different type of costs over here on the left, and then the expected cost in 2018. Svensson manufactured 8,000 CMCBs in 2017 and 40 batches of 200. In 2018, Svensson anticipates needing 10,000 CMCBs. The CMCBs will be produced in 80 batches of 125 each. Now, the Minton Corporation has approached Svensson about supplying CMCBs to Svensson in 2018 at $300 per CMCB on whatever delivery schedule Svensson wants. So in other words, the Minton Corporation has come to our company, the Svensson Corporation, and they're offering to make this product for us. So we have to, and they're offering it at $300 per CMCB, so per unit. So the first thing we're asked to do is calculate the total expected manufacturing cost per unit of making CMBCs in 2018. So we want to look at these costs of 2018 both on a per unit basis and on an aggregate basis. And that's going to be important to look at a little bit later. So first of all, let's take a look at these numbers here in this chart. Current costs in 2017. Are these individual dollar amounts relevant or irrelevant information? Well, they would be irrelevant information. Why? Because these are sunk costs. These are costs that have already been incurred. We are incurring them now. So these are irrelevant to the decision-making process. However, the costs expected in 2018 are relevant. Why? Because they expect to be in the future. These are future costs. And as we're going to see when we can find out what these per unit costs are, then we're going to, in step 2, we're going to calculate should we buy this from the other company or should we make it in-house. So this is going to be an important part of the decision-making process because 1, it's in the future, and 2, it's going to differ among alternatives because in one situation, we're going to make it, and then the alternative situation is to buy it from the Minton Corporation. So let's take a look at 2018's costs. Now, our expected cost for direct materials per CMBC is $170. So, and if I anticipate needing 10,000 CMCBs, what is the total direct materials cost per CMBC? Well, it's going to be $170 times 10,000. So my total manufacturing cost for direct materials is going to be $1,700,000. Now let's take a look at direct manufacturing labor cost per CMBC. In the future, next year, I expect to spend $45 per unit. So how much is that on a total level? On a total direct cost or cost of direct labor, take my $45 of direct labor per unit times the 10,000 units, and that's going to get me $450,000. Now, why am I going off the 10,000 CMBCs and not the 8,000? Because 8,000 is what we've already produced in 2017. That's not what we're looking at. We're looking at next year's needs. So if we're looking at expected costs in 2018, we want to relate that to production in 2018. Okay. So let's take a look here. Variable manufacturing costs per batch for setups, materials handling, and quality control. So all other variable manufacturing costs are going to be $1,500 in 2018. Now, how much is that on an aggregate level? Well, on an aggregate level, that's going to be 120,000. And how do we get, and then $12 on a per unit basis. How do we get that? Well, I'm going to take the total amount for my total manufacturing costs here. I'm going to take my $1,500 per batch. I'm going to multiply it by the number of batches that I'm going to need. And it says the CMBCs will be produced in 80 batches of 125 each. So I'm going to have 80 batches, and the cost per batch is going to be $1,500. And that's where I get my $120,000 from. Now I'm going to take my total cost of $120,000 and divide that by the number of units that I'm going to make. And I'm going to make 10,000 CMCBs. So that's going to give me 120,000 divided by 10,000 CMBCs, which give me $12 per unit. Now, let's take a look at fixed manufacturing costs. And before we go over here, let's take a look here. Fixed manufacturing costs. Fixed manufacturing overhead costs that can be avoided if CMBCs are not made. So is this relevant in the decision-making process? It absolutely is. Why? Because if we keep it in-house and keep manufacturing those CMBCs, we're going to incur this $320,000. However, we're not going to incur that $320,000 with the fixed costs if the CMBCs are made by the Minton Corporation. But just to figure out our total manufacturing costs of making CMBCs and the manufacturing cost per unit, so we can make our, should I make it in-house and should I outsource it? We're going to include these because in one scenario we're going to have this, in the other scenario we're not going to have it. So fixed manufacturing costs, $320,000. Fixed manufacturing costs that can be avoided. So I'm going to take the $320,000 and divide that by 10,000 units that we're going to make, and that's going to be $32 per unit. Now let's take a look at the fixed costs that are not going to be avoided, or they're going to be incurred no matter what. Fixed manufacturing overhead costs of plant depreciation, insurance, administration that cannot be avoided even if CMCBs are not made. So whether we make the CMCBs or not, we're going to incur the $800,000 of cost. Now we need to include that for total manufacturing costs so we get a sense of those per unit, but we're not going to include that in our decision-making process. So, because it will not differ among alternatives. So let's go ahead here and include that. Unavoidable fixed manufacturing costs, $800,000. And it's $80 per unit if I take that $800,000 and spread that out over 10,000 units. So what is my total manufacturing cost? $339 per unit. And that's full production cost. Avoidable and unavoidable costs with regard to manufacturing cost per unit. And the total manufacturing cost of CMBCs is $3,390,000. Now, let's take a look at requirement 2. Suppose the capacity, let's see. Suppose the capacity currently to make CMBCs will become idle if Svensson purchases CMCBs from Minton. On the basis of financial considerations alone, should Svensson make CMCBs or buy them from Minton, and show you calculations. So if we have that outsourced, our facilities will remain idle. So we're going to have certain costs that are not going to differ among alternatives. So let's take a look at the items that do differ among alternatives. And the first one here is going to be the cost of purchasing CMCBs from Minton. The product cost they chose to sell it to us for is $300 on whatever delivery. So if it's going to cost me $300, and then for making 10,000 units, it's going to cost me from the Minton company $3 million. So now let's take a look at direct materials. Direct materials, if I make it, then I'm going to incur costs of $1,700,000, just what we talked about up there. But if I buy the product from Mint and Company, then I'm not going to incur those costs, and that's why they're not there. So what about the cost of direct manufacturing labor? Well, again, if I make the CMCBs, I'm going to incur $450,000 in direct labor costs. I will not incur those costs if I buy those products. So since they do differ among alternatives and they are expected to be future, this is a relevant piece of information I need to know. Now, what about variable batch manufacturing costs? Well, my variable batch manufacturing costs, I'm going to have what? $12 per unit. We determined that up there for a total of $120,000. Is that relevant? Yes, because batch costs will only be incurred if we make the CMCBs, but if we buy them, we will not incur any variable batch manufacturing costs. So that's going to be relevant. So we want to make sure we make that distinction. Now, what about the avoidable fixed manufacturing costs? Well, remember we talked about that there's $320,000 worth of cost that we can avoid if we decide that we're going to outsource this production and not keep it in-house. So does that make a difference? Yes, because that's avoidable. I'm going to incur those costs if I make the product, but I can avoid those costs if I'm going to buy it from the Minton Corporation. So what do we have here? If I'm looking at just the relevant information, then the cost of making it, the relevant information, it's going to cost me $3 million to buy the 10,000 units, but it's only going to cost me in relevant costs $2,590,000. So what do we have here? We have here a decision in favor of keeping that in-house. And how much is that? Well, $3 million minus $2,590,000. So I expect to save $410,000 by keeping the production of CMCBs in-house. So it's going to cost, in other words, it's going to cost me $410,000 more to buy them from Minton Corporation. And again, this is where we have to really pay attention and figure out what costs are avoidable and what costs are not avoidable. And this goes back to the premise that's in the book that not all variable costs are automatically relevant and not all fixed costs are irrelevant. Variable costs are not always relevant. Fixed costs are not always irrelevant. There are situations where some variable costs are not going to be relevant to the decision-making process, and there are times where fixed manufacturing costs are going to be relevant to the decision-making process. And we saw an illustration of that here, where we can avoid $320,000 worth of fixed costs if we decide to outsource production to the Minton Corporation. So now let's say that let's see that now suppose that as Svensson purchases CMCBs from Minton, its best alternative use of the capacity currently used for making CMCBs is to make and sell a special circuit boards to the Essex Corporation, the CB3s. Svensson estimates the following incremental revenues and costs from CB3s. If we take that idle manufacturing that we expect to have, because if we outsource it, that's not the end of the discussion, just because it costs more to outsource. We're going to take a look and see, are there any alternative uses to the production that we no longer have? Can we free up with that freed up capacity, can we make another profit that's actually more profitable? So in this case, we're going to have revenues of $2 million if we choose to make the CB3s. However, incremental future costs are going to be $2,150,000. So should we make or buy them from Minton? And show you calculations, and we're going to calculate this. So if I add in $2 million of additional revenue and subtract out the $2,150,000 of costs, I'm actually going to lose $150,000 by making something instead of just leaving that additional space idle. So the true cost of outsourcing is not only going to be the $410,000 that we talked about up here, but if I start to make the CB3, it's going to that decision then is going to cost me an additional $410,000. So the loss of $150,000 plus $410,000, which was the difference here, and the decision to outsource could potentially be an expensive one and actually cost me $560,000 more. So do we want to outsource this even to begin with? No. Now let's say that, and just for an example, let's say that expected revenues were to be $3 million. So as of right now, if revenues are only $2 million and it's going to cost me a $1.5 million, then no, I don't want to do that because I'm losing even more money. But what if my incremental future revenues were $3 million and it's only going to cost me $2,150,000 to generate that? I have gained additional operating income of $850,000 that I otherwise wouldn't have had if I outsourced. So if I outsource, I'm losing $410,000 because those parts are going to cost me more to buy. But if I'm losing $410,000, but I'm gaining $850,000 worth of additional operating income, assuming that incremental future revenues were $3 million instead of $2 million, then the net gain to operating income is going to be $440,000. And in that situation, we would consider, based on financial terms, to go ahead and maybe outsource this, because freeing up that capacity is going to generate even more operating income than what I'm losing by outsourcing. So these are some of the situations here, and where we have an alternative use of these fixed costs, of the idle facilities, of the capacity that we have. Now we have freed up capacity. If we outsource, what can we do to make additional operating income and to make our operating income even bigger than it was before? If operating income at the end of the day increases after taking into account the avoidable fixed manufacturing costs plus any additional operating income, if that all comes out and we make this analysis, the operating income is going to increase at the end of the day, then we should go ahead and do that. But under the original assumption, which we only had $2 million worth of revenue and costs of $2,150,000, that would not be a wise decision. So this is Leroy Meadows. I want to thank you for joining me.